Target reported earnings before the market opened on Wednesday, and the reaction was really negative from the market. Shares are down about 20%. I'm recording this late in the trading day on Wednesday, and not a lot of positive reaction from the market. But I do want to put this report into context because I think when you pull back a little bit, Target's not in a terrible position, but some of the numbers that they're reporting are indicating that things aren't getting But some of what they're reporting is indicating that things aren't getting better as quickly as a lot of investors hoped, and they're maybe not keeping pace with Walmart. That's really the company that you want to compare them to right now. So there's some good and some bad, but hopefully this will sort of level set things for investors. And, I think the price is a little bit better today than it was even 24 hours ago. But let's go through all those details. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsored The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start with that high level look at where we are for Target. And this is a chart of the company's revenue and net income going back to 2016. So the January 2017 fiscal year would have been mostly in 2016. But you can see that the company's revenue has jumped and net income is up sharply as well. Ironically, over that period of time, shares are only up about 71%. But the other thing, when you look at those numbers, right now, Target's market cap is $72 billion. The enterprise value is about $88 billion. So that means the price to earnings multiple, at least on a trailing 12 months basis, is about 16. Enterprise value to sales is about 0.8. So reasonable valuation, but let's get into some of those numbers and why the market isn't really excited about the stock right now. This is a look at the third quarter report, and the highlight numbers is always comparable sales for a retailer like this. They increased 0.3%, and what they said is driven by strong traffic and digital performance. Guest traffic was up 2.4%, so that's a really solid number. The interesting thing was that inside that comparable sales increase of 0.3%, in-store sales were down 1.9%, and digital sales were up 10.8%. What's happening here is that people are just physically going into Target less, or they're not actually going in less, they're going in more, but they're spending less every time that they're in there by a couple of percentage points. This is going to ultimately put pressure on margins. I'll get to that in just a bit. The flip side is that Target is doing more digital sales. So that would be Drive Up, and then their Target 360, where you can be a member and get deliveries for your products that's through their Shipped service. So those digital sales are doing extremely well, but the in-store sales not quite holding not quite the same strength. You can see double-digit growth in Drive Up. Beauty sales were up more than 6%. Food and beverage grew low single digits compared to a year ago. This is actually one I think is really important for Target. If people are going into Target to do their grocery shopping, that's going to be a really sticky business for them long term. We can see that the margin rate was down 0.2 percentage points from a year earlier, and year-to-date gross margin is up a little bit, but maybe not as much as investors expected. Let's get into some of the guidance numbers, because this is what I think is really the focus of the market today. If you go back to, this is fourth quarter of 2023. So this was the quarter that ended in January of this year. Earnings for the quarter were $2.98. So that's kind of the bar that we're looking for the fourth quarter. And what management said was earnings were going to be down to $1.58 to $2.45. On a full year basis, that means that earnings are going to be about $8.30 to $8.90. So fourth quarter, always really important for retailers because that's when your holiday shopping often happens. But Target is expecting things to be down a little bit on a revenue basis, approximately flat on a comparable sales basis. So a lot of this pressure is happening on the margin side. I think this is going to be the reaction to a lot of the inflation that happened over the last couple of years is customers are going to push back first on retailers, then retailers are going to be able to push back on some of their suppliers. So we're seeing that crunch right now at Target. Capital returns to shareholders do continue, paid a dividend of $516 million in the third quarter. That was up slightly from a year ago, and then repurchased another 354 million shares. So if that continues, that can be a way to return cash to shareholders if Target continues to remain profitable. I want to go through some of this infographic here because this gives a nice look at how Target is doing. You can see here the comparable sales number. That's going to be the highlight number that you're going to see everywhere. But the in-store number down a little bit, digital up, and traffic up. I think ultimately what you want is to have traffic at Target. And there's going to be ebbs and flows in how much people are spending. But if they're physically going to the store or if they're ordering more digitally, that's going to be good for Target long term. price reductions taking place, that's something that is going to hit those margins. So when they're reducing prices, if there's not a commensurate reduction in the supply cost, that's where you're going to see that margin pressure. And we haven't seen that same price pressure over the last couple of years as inflation took over, but now we're starting to see the pushback against that. So that's really the dynamic I think we're seeing here. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, I think one of the reasons the reaction is so strong by the market is because Walmart told a very different story when their earnings came out. You can see that in this chart right here. Walmart's same-store sales are actually increasing 5.1%. Now, I'll note that the increase is happening now. They did not have the same increase during the pandemic when Target really leaned into their digital services, the things like Drive Up and Pickup. And Walmart is also seeing some of that same margin pressure. You can see that with their operating margin declining. So I think it's pretty clear that customers are looking for lower prices. They're looking for discounts. They're looking to spend less money on discretionary items. Those are the things that did really well during the pandemic. And we're starting to pull back from that. So that's not really surprising. But again, you look at Target, they're continuing to have an increase in the number of people going to the stores. You do have a small increase in comparable store sales. And long term, their revenue continues to go up. I think what they really need to do is lean into those digital solutions, lean into those delivery solutions in particular. I'm a member of Target 360. That's where you get free delivery. It's not really free delivery because they do ask for a tip, which is a whole nother story with Target. But those are the kind of things where they can offer the products that are in a Target that a lot of, especially urban customers, are comfortable with and get them to your door within a couple of hours. That's a way that they're going to be able to compete with a company like Amazon. Target's a lot of times not directly competing with Walmart because they operate in different geographic environments. Walmart is much more suburban and rural. Target is going to be much more urban centers and then kind of the inner suburb areas. So there's a little bit of differences in where they're competing. But I think this wasn't a terrible report. I'm a little bit surprised the stock is down 20%, but that's in part because the market was seeing that things are getting a little bit better at Walmart, hoping that that meant that the economy is getting a little bit better, that consumers are going to be spending a little bit more. Maybe this is going to be a good holiday season. Target kind of poured cold water on that. So I think that's the way that we should look at this report, is that there was a little bit more optimism as the stock market has risen and Target told a very different story. So we'll see how these things play out. I think the valuation for Target is relatively appealing today. The stock is in that 15 to 16 price to earnings multiple. They are returning cash to shareholders through a dividend and buybacks. I think there is a bright solution in those digital solutions. So I would like to see them lean into that more, grow even faster than 10% with those digital solutions. That should be a segment that's growing at 20, maybe even 30% if they can get more and more customers in that Target 360. But we'll see how things play out for Target. Obviously a bad day for the stock, but hopefully this put a little bit of context into what's going on at the company. But let me know your thoughts on this earnings report. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.